Hi there, and welcome to this week's edition of the Energy Action Market Wrap, where we let you know what's happened in the energy market in the past week. My name is Andy Young, and I'm the General Manager of Business Services here at Energy Action. Well, over the last quarter or so, we've seen some changes to the way that generation is dispatched around the NEM. Now, this is brought about by the reduction of demand, but also due to some thermal plant outages. Overall, and on average, we've seen coal-fired generation decrease by 1,100 megawatts and gas-fired generation decreased by around about 600 megawatts on average. Now, this has been partially offset by large-scale renewables, which has seen an increase of 550 megawatts on average compared to the same period last year. According to AEMO, the market continues to be dominated by coal-fired generation. 47% of spot prices have been set by coal-fired generation, while only 29% was set by hydro and 19% was set by gas-fired generation. These changes to dispatch generation, combined with an outage in the interconnector between South Australia and Victoria earlier in the year, has seen a significant increase in the price of frequency control ancillary service charges, or FCAS. And retailers, as a result, are going to seek to recover these costs. Ancillary services are actually pass-through charges, but retailers look at them in different ways. Some of them look at it on a regional basis, while others will seek to recover costs on a national market basis. In either case, retailers are going to seek to recover those costs through the energy bill or through the retailer's bill, and this is likely to be seen as an adjustment on the bill. Forward wholesale prices have been consolidating over the last few weeks. We've seen 2021 prices stopping the decline, except in Queensland where there's been some further falls. And in calendar 2022 and 2023, we've also begun to see a flattening of the curve there. And this could be interpreted as a sign that the market has achieved the bottom. The significant drop in the electricity market was partly due to reduced operational demand, but also due to reduced gas prices. Now, these fundamental prices are fading away as the beginning starts showing some signs of reopening, and we expect as a result demand to start increasing. In New South Wales, as I said, the market is consolidating, and the timing is even becoming more important to secure forward contracts for that period. In Queensland, the market actually continues to drop a little further, but we actually expect this trend to stop fairly soon. Victorian and South Australian market have a slightly different dynamic. Calendar 2021 prices are being supported at around about the $55 a megawatt area, while calendar 2022 and 2023 prices are pointing slightly lower. While we expect prices in Western Australia to decline overall, the operational demand has increased due to some weather conditions over there, which has temporarily offset the impact of increased generation. Year on year, wind generation has actually increased by around about 7% or 17 megawatts on average, and this is predominantly due to increased generation at existing wind farms. Installed capacity on rooftop PV continues to increase. We've seen an increase of around about 63 megawatts over the last quarter there. And gas-fired generation has increased on average by around about 80 megawatts. Gas prices continue to soften despite a moderate increase in demand. But despite lower international demand, gas production has continued to surge. At attractive prices and lower demand have led to increased storage levels in the market. We expect a period of consolidation in the gas market, so we don't really see much further falls here. In the certificates market, LGCs are currently trading at $32.25 a certificate. Hydro generation has actually increased in Tasmania, New South Wales and Queensland compared to the Q1 period in 2019. Lake Eucumbene levels have jumped up to just over 28%. This, coupled with increased intermittent renewable energy, especially from wind, should lead to further LGC certificate supply. So we would expect downward pressure on those certificates. Victorian VEECs are currently trading at around about $34.15 a certificate, and the ESCIs in New South Wales are pretty stable at around about $27.15. In the news this week, Energy Australia has indicated that it's going to wait till September to provide the final go-ahead for a new power station located just outside of Wollongong in New South Wales. The Tallawarra B power station is a $400 million project which is going to generate 300 megawatts using gas as the fuel source. In other news, the Australian Energy Market Operator has asked the Australian Energy Regulator to delay the introduction of 5-minute pool price settlements. This was originally due to be introduced in July 2021, but is now expected to be introduced in July 2022. The AER is actually expected to make a final determination on this matter in July. All right, well, that's it for this week. Thanks very much, everybody. Stay safe and cheers for now.